Hello everyone, welcome back to another video. Today we're going to be covering the Chapter 4 questions from the Investment Banking, Valuation, Leverage Buyouts, and M&A second edition textbook by Joshua Rosenbaum and Joshua Pearl. Now this is a great textbook for any entry-level analysts and students interested in the investment banking and private equity space. And in Chapter 4, we kind of covered the introduction to the private equity space and the LBO transaction. And it's much more theory, wordy, and I already released the comprehensive video. It's quite a long video, but I do recommend that you watch it before you try these questions. And afterwards, you can come back and kind of test your knowledge after you've watched the video. But essentially, Chapter 4 just provides an overview of the LBO transaction, the different players in the space, how equity returns are leveraged and increased as we increase the amount of debt in the respective transaction. We talk about internal rates of return. We talk about the characteristics of a strong LBO candidate and many more things that are very relevant for the private equity space. So anyone who's interested in going into that space will find that video very helpful. In Chapter 5, we'll go into more of a technical analysis and looking at the actual LBO model. But in Chapter 4, it's more theory-based. So let's get started. Question 1. Which of the following are third-party investors that provide financial sponsors with investment capital? So essentially, the question is asking us, which of the following provides private equity firms with financing? Who commits capital to the funds that they raise? Pension funds, insurance companies, university endowments, and wealthy families. Well, all four of them would probably be the providers of capital, because at the end of the day, you're looking for wealthy individuals or organizations who can make capital commitments to support the fund, right? So it'd be D. So third-party investors that invest money with PE firms include public and corporate pension funds, insurance companies, endowments and foundations, sovereign wealth funds, and wealthy family or individuals. Sponsor partners and investment professionals may also invest their own money in particular investment opportunities. Now, question 2. Which of the following is not part of an investment bank's financing commitment? A commitment letter, B, institutional letter, C, an engagement letter, or D, a fee letter? The answer would be B, the institutional letter. Now, a commitment letter for the bank debt and a bridge facility, commits the investment bank, the commercial side of the investment bank, to ensuring that financing will be provided to complete the transaction. And so that bridge facility is really that short-term solution. A bridge facility essentially bridges the financing gap between the completion of the transaction and when the company is able to really raise that money and pay down that bridge facility. The engagement letter for the investment bank really commits the company to underwriting the bonds on behalf of the issuer. And at the same time, the fee letter sets forth the various fees to complete the financing of that respective deal. Now, question number 3. Which of the following would be potential LBO candidates? 1. Troubled companies. 2. Companies in fragmented markets. 3. Solid performing companies. Or 4. Non-core subsidiaries. The key takeaway to remember from our Chapter 4 video is that with an LBO transaction, any company can be an LBO candidate as long as the financial sponsor, the private equity firm, can achieve its targeted internal rate of return based on the projections, base projections and also optimistic projections. So any company can be an LBO candidate. It just needs to generate strong free cash flow in order to pay down debt and increase the returns on equity. So really, it'd be 1, 2, 3, and 4. So all of them, or D. Okay, now question 4. The ability to maximize leverage in an LBO transaction is facilitated for a company with which of the following characteristics? 1. A track record for bolt-on acquisitions. B. A tight covenant package. C. A strong asset base. Or D. A large debt balance. So the question is asking us which of these provides the ability to maximize leverage in an LBO transaction. Essentially, that means which of these would increase the confidence of the lender to lend more and therefore increase the leverage on that transaction, increase the leverage returns of equity returns for that respective financial sponsor. Well, the answer would be C, a strong asset base. A strong asset base pledged as collateral against a loan benefits lenders by increasing the likelihood of principal recovery in the event of bankruptcy and liquidation. This in turn increases their willingness to provide debt to the target. The target's asset base is particularly important in the leveraged loan market, where the value of the assets help dictate the amount of bank debt available. Question 5. Which of the following are common exit strategies for financial sponsors? 1. Refinancing. 2. An IPO. 3. A sale to a strategic buyer. And 4. A sale to another sponsor. So in the Chapter 4 video, we talked about the exit strategies for a financial sponsor, and there are 4 key ones: a sale to a third party, an IPO, a dividend recapitalization, and buying the bonds that were initially issued to complete the transaction at a below par rate. Now, dividend recap and buying the bonds at a lower value are not exit strategies. They still own the company post, that strategy. But selling to a third party and conducting an IPO are exit strategies where they can liquidate their holdings, right? So an IPO and a sale to either a strategic buyer or another sponsor, which are considered a third party, would be the options. So the answer would be 2, 3, and 4. 2, 3, and 4. So it'd be D. Yes. So question 6. What percent of a sponsor's existing equity ownership in the target is kept following a dividend recapitalization? So, with a dividend recap, sorry, I completely blanked out there. So with a dividend recap, remember, we're raising money using the business. We're raising additional debt and paying out the money that was raised to the equity sponsors, right? So if a company is doing very well, generating a lot of strong free cash flow, paying down its debt ahead of its debt repayment schedule, then what equity sponsors, the private equity firm, can do is can raise additional debt, and that money that is raised is paid out as a dividend to already capitalize on a strong investment. But when you're raising that money, no ownership changes. So really, when you are conducting a dividend recapitalization, what percent of a sponsor's existing equity ownership in the target is kept? Well, it would be 100% because there would be no change. So it would be D. A dividend recap provides a sponsor with the added benefit of retaining 100% of its existing ownership position in the target, thus preserving the ability to share in any future upside potential and the option to pursue a sale or IPO at a future date. Question 7. Asset-backed lending facilities, ABL facilities, are generally secured by what? A, current assets, B, current liabilities, C, long-term debt, or D, pension assets? Well, the answer would be A, current assets, because again, they're the most liquid. So ABL facilities are secured by a first priority lien on all current assets, typically accounts receivable and inventory of the borrower, and may include a second priority lien on all other assets. So because again, accounts receivable and inventory are considered current assets and are considered probably the most liquid, excluding cash and cash equivalents. Well, then those are used to back up the asset-backed lending facilities, because again, they cost less because there's collateral issued against them. So if the company ever fails to really pay back the asset-backed lending facility, the accounts receivable and inventory are claimed by the lender. Question 8. On average, what percentage of an LBO financing is funded by the sponsor's equity contribution? A, 10%, B, 30%, C, 70%, or D, 90%? Well, we can already rule out C and D, 70 and 90%, because with an LBO transaction, the entire purpose of an LBO transaction is to fund majority of it through debt in order to leverage the equity contribution. Now, between 10% and 30%, which one's the more likely equity contribution? Well, back in the day, in the 1980s, when the junk bond market was performing very well, A is a realistic answer. It could have been about 10% because, back in the day, when the private equity industry was quite new, no one really kind of looked at the risks with regards to having such a low equity contribution. But now in the modern private equity industry, B is the more likely answer. So it'd be B, 30%. Now, the equity contribution percentage typically ranges from approximately 25% to 40% of the LBO financing structure, although this may vary depending on debt market conditions, the type of company, and the purchase multiple paid. Question 9. Call protection mitigates which type of risk for debt investors when interest rates are declining? A, credit risk, B, operational risk, C, reinvestment risk, or D, extension risk? It would be C, the reinvestment risk. So call premiums protect investors from having debt with an attractive yield refinanced long before maturity, so paying back that bond earlier than when it should be repaid, thereby mitigating reinvestment risk in the event market interest rates decline. Reinvestment risk is the risk that future coupons from a bond will not be reinvested at the existing interest rate when the bond was initially purchased. So if interest rates fall from the lender's perspective, the bond, which is paid back early, and that principal is reinvested at a lower rate, and therefore that is considered the reinvestment risk. Therefore, to really mitigate and avoid that, deter the borrower from paying back the bond early, call premiums are added to the bond in order to really deter them, so that if they really do want to pay down that bond, then they also have to pay a premium on top of the principal. Question 10. Which of the following is not a covenant classification? A, financial, B, limitation, C, negative, and D, affirmative. Well, in my high yield bond video, I talked about this, so I do recommend that you check that out on my channel. But essentially, the answer is B, limitation. That's not a covenant classification. I can define the other three. A financial classification is essentially defining either a leverage ratio or a credit rating that needs to be maintained. It's a financial rating that needs to be maintained. It's the financial covenant. A negative covenant essentially means I, as the business, will not blank. I'm not going to do that. It's a negative covenant. I'm not going to do that. An affirmative covenant is the opposite. I will do blank. I will maintain blank. I will ensure that I do this blank, right? So there are a lot of different covenants that can be made in the affirmative or the negative or the financial. So the answer, which is not a covenant classification, is B, the limitation. Question 11. Financial maintenance covenants are typical for blank, while blank typically have incurrence covenants. Well, we know right away that with bank debt is considered more senior in the capital structure, right? And so financial maintenance covenants ensure the safety of that debt, because it's very strict to have financial maintenance covenants. You have to maintain a certain leverage ratio, maybe a interest coverage ratio, and so that's very, very strict relative to just having maybe incurrence covenants, right? So bank debt would be the first blank, while blank typically have only incurrence covenants, which is high yield debt. It's considered much more risky. And so, the covenants that are put on high yield debt are less stricter than the financial maintenance covenants that are placed on the bank debt, which is considered much safer. So the answer would be D, bank debt and then high yield bonds. So while many of the covenants in credit agreements are similar in nature, a key difference is that traditional bank debt features financial maintenance covenants, while high-yield bonds have less restrictive incurrence covenants. Question 12. Which one of the following is not a financial maintenance covenant? So we talked about this. So with bonds, with bank debt, financial maintenance covenants are very, very strict. And we talked about the covenant classification question. A financial covenant defines a certain ratio defined within the financial performance of the company. So maximum total leverage, B, maximum senior secured leverage, C, minimum dividend payments, or D, minimum interest coverage. So a financial maintenance covenant defines that you have to meet X based on your financial performance. We can already conclude that D is correct. Minimum interest coverage, that is a covenant. Minimum dividend payments, you have to pay X amount. A maximum total leverage and a maximum senior secured leverage. Well, maximum total leverage makes sense, whereas maximum senior secured leverage doesn't make that much sense. So it would be C. Minimum dividend payments. A financial maintenance covenants require the borrower to maintain a certain credit profile at all times through compliance with certain financial ratios or tests on a quarterly basis. Financial maintenance covenants are also designed to limit the borrower's ability to take certain actions that may be adverse to lenders. So we talked about the three covenants. So we have maximum total leverage, which makes sense. We have maximum senior secured leverage, which defines the amount of leverage with regards to senior secured debt, and interest coverage, which meets the interest expense ratio on a quarterly basis. With minimum dividend payments, that doesn't really make sense for it to be a financial maintenance covenant. Okay, so question 13, which of the following would not be classified as a qualified institutional buyer? So a QIB. A retail investor with under 25 million in net worth, an equity asset manager with 200 million, an insurance company with 500 million, or a mutual fund with $10 billion. Well, it would be a retail investor with under 25 million in net worth. QIBs are institutions that in aggregate own and invest on a discretionary basis at least 100 million in securities. So a QIB must have at least 100 million assets under management. Question 14. With financial maintenance covenants, leverage ratios typically blank throughout the life of the loan, while coverage ratios typically blank. Well, throughout the life of a loan, a company, of course, wants to pay down a little bit of the initial principal and at the same time cover the interest expenses, right? So they're paying down the loan. So with leverage ratios, a leverage ratio indicates, the amount of debt relative to the amount of equity, right? So if debt is declining over the life of the loan because you're paying down that loan, then leverage ratios typically decline. Whereas coverage ratios, which indicate the ability to cover the remaining amount of debt for the company, typically increase because they're paying down that debt, and therefore it becomes easier to cover the remaining amount of debt, right? So leverage ratios typically decrease, while coverage ratios typically increase. So it'd be C. So required maintenance leverage ratios typically decrease throughout the term of the loan, while the coverage ratios typically increase over this time. This requires the borrower to improve its credit profile by repaying debt and or growing cash flow in accordance with the financial projections it presents to lenders during the syndication. And then final question, question 15. What is the current yield of a $1,000 bond at face value with a coupon of 6% that is trading at par? So the key to this question is that it's trading at par. So if the face value is $1,000 and it's trading at par, it means that it's still trading at $1,000. Therefore, the yield to maturity equals the coupon rate of 6%. So the answer would be B, 6%. The coupon rate represents the percentage of interest the purchaser of a bond will be paid by the issuer. A $1,000 bond trading at par with 6% interest has a coupon rate, a current yield of 6% as well, because it's not trading at a premium or under premium. Okay. So, as always, if you did enjoy the video, please like and subscribe to the channel for more videos. If you have any questions with regards to the questions that I've talked about, please do comment below. And I do recommend that you buy the textbook, the Joshua Pearl and Joshua Rosenbaum investment banking textbook. And if you haven't watched the Chapter 4 video already with regards to the questions that we're referring to over here, I do recommend that you watch that video as well. As always, guys, take care, and hopefully you guys found this video very helpful. Have a nice day.